Before you sign the paperwork for your new car, it's a good idea to understand the ins and outs of your auto loan. It doesn't have to be rocket science. All you really need is a handle on the basics, and that will help ensure you get the best auto loan and rate for you. This video will cover 3 fundamental aspects of auto loans. The first are the common types of auto loans. Second, the terminology and buzzwords that you're most likely to encounter. And 3, places you can apply for an auto loan. For more helpful videos like this, hit that subscribe button. It depends on your needs, but there are 4 common types of auto loans. The first one is a purchase loan, and it's pretty straightforward. This is the loan that you get if you're going to buy a new or used car from a dealership. And typically, in a purchase loan, you're going to find lower interest rates on new cars versus used cars. Next are private party loans, which many lenders don't offer because private party financing is seen as riskier than a standard purchase loan. You'll seek out a private party loan if you're buying a vehicle from a private seller. Then there are lease buyout loans. Lease agreements come with fixed monthly payments and will last anywhere from 12 to 36 months. Drivers return lease vehicles at the end of the term unless they decide to purchase it afterwards with a lease buyout loan. And finally, there are refinancing loans. What these do is alter your current loan, usually the term or the interest rate, but the idea is that when you refinance, you get a lower monthly payment. There are also cash-out refinance loans, which allow you to borrow more money by accessing the equity in your vehicle. Auto loans can range anywhere from 12 to 84 months in length. Ideally, you do not want to go any longer than 60 months or 5 years. The low payments of a 72-month or 84-month loan can be enticing, but you'll be paying for your vehicle beyond its best years and you can quickly end up underwater in your new car, meaning you will owe more than what it's worth. If you do a lot of driving, say a long commute to work each day, avoid a 72-month or 84-month loan, as the miles on your car have the potential to add up quickly. Understanding the terms used by auto lenders will help you. For example, interest rates and APRs are often used interchangeably, but there are subtle differences between the two. Interest rate refers to the actual percentage of interest a lender charges you to borrow money. APRs include the base interest rate but also factor in any additional fees. Due to this distinction, you'll get a more accurate measure of how much you will actually pay by looking at the APR. Auto loans have different interest rates depending on the borrower and the lender, although there are a few things to consider across the board. This includes things like the federal interest rate and overall market conditions. The type of vehicle you are buying matters too, as newer vehicles are likely to give you the best interest rates versus a car with higher mileage. Your debt-to-income ratio, or DTI ratio, also impacts your auto loan. Your DTI ratio is your percentage of monthly debt payments compared to your monthly gross income. A DTI ratio of 43% or higher is considered risky by just about any lender, making it less likely you will get an auto loan. Each lender will have its disadvantages and downsides, so it's best to fully explore your options. Here are a few common types of auto lending institutions. Traditional banks continue to be popular choices because of their competitive rates and the discounts given to customers who already have checking accounts or other lines of credit. Meanwhile, credit unions, member-owned organizations, are similar to banks, but they often have less strict lending requirements and lower interest rates. It's usually easy to join a credit union with either a nominal fee or a charity donation. One of the most common places to secure a loan is the dealership, where you buy your car. In-house financing options are prevalent at car dealerships, and you might find lower interest rates from dealers than banks. Larger dealerships sometimes extend extremely low APR offers to those with excellent credit. Keep in mind, though, that auto dealers will try and tack on extras, such as warranty and other protection options, which may or may not be necessary for all drivers. And finally, there are online lenders. You will find a variety of online options for auto loans, some of which are from direct lenders with the backing of large financial institutions. Below is a link to a helpful article that goes more in depth on what we discussed in this video. That article will also help you understand how credit scores affect auto loan rates, the difference between pre-approval and pre-qualification, and other tips for getting the best auto loan rates. For more helpful videos like this, subscribe to our YouTube channel. In Detroit, on behalf of Automoblog, I'm Carl Anthony.